Good afternoon, you're watching Bloomberg Quint Live. I'm Alex Matthew. These are the headlines. Markets hunt for direction as Nifty trades with muted moves. The mid-caps trade under pressure while small caps hold up in trade. Rising consumer prices will pressure the RBI to hike rates over the next 2 years, according to Goldman Sachs. Personal and healthcare products get cheaper after the government prompts FMCG companies to pass on the benefit of lower goods and services tax to consumers. Zee Entertainment gains more than 3% after Macquarie says it expects a turnaround in 3 key loss-making segments. Now don't go anywhere because up next is Hot Money with Darshan Mehta. Darshan?
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome my experts on the show. Amit Mantri of 2.2 Capital, Lancelot Cunha of Wealth Advisors, and independent market advisor Sharmila Joshi. She joins us on the show. Thank you all of you for joining us on the show. The stocks that we'll talk about on Hot Money today will be McLeod Russel, Reliance Communication, Phoenix Mills, IFP Industries, and the real estate sector. Let's start with the first one, and that is McLeod Russel. The count has been buzzing over the past few days. Today it's flat, but yesterday it was gaining. Low tea production is something that the management has indicated. Will that is boosting prices. Will this sustain? We had the management yesterday on our channel, and he believes that he already says that tea prices are higher by almost 5 rupees, and he believes that probably a 20 rupee increase is something that can happen. Is this commodity cycle sustainable? We'll ask our guest. I'll start with you, Lancelot. Any view on McLeod Russel or the tea sector?
Well, I think that, because this year we had a problem in Kenya, and that's why you had seen the tea prices rise. But going forward, the next year's production is expected to be a bumper production, and that should see tea prices remain soft or within this relative range. So, given that outlook, this is being a cyclical industry. I think you are seeing the McLeod now trade at almost 20 times its FY19 earnings, which is fairly expensive for a company like McLeod Russel. So I would be neutral on this company at this point. Okay,
you don't see that there could be substantial upsides that could come in because even in Kenya, as you spoke about, there could be production issues. Here also in Assam, production is down 27%. The other area where it operates in West Bengal, production is down 20%. So won't that make that the next few quarters will be very strong for?
Tea is mostly a global pricing is mostly determined by global factors. So given that next year you will see a higher production because of the acreage under production has increased, and weather being good, you should see a higher production globally. So if that happens, then you will see again tea prices being relatively soft. That rise in prices will not be that high because after all, being a global commodity, you can always bring in tea and distribute it if you need.
Okay. Would you bet on a commodity like tea or a company like McLeod Russel?
Well, I think in the short term you can, because at the end of the day it's precisely what you're talking of, that if you see tea prices going up, you've seen the rally sort of start. And that could be the sort of trigger that these companies have been waiting for, because even in sugar, if you remember, that's how the sort of news flow started, with prices going up and companies coming back into the green. I think the same cycle can repeat with tea companies, and McLeod Russel is positioned that way with exports as well as domestic business, etc. So they would definitely benefit from higher tea prices. So maybe not too much from current levels, but I think you can easily expect levels of closer to 215, 220 on the stock. So I think this current rally in tea prices can take the stock at least to that level.
Okay. Amit, do you have a view on McLeod Russel or the tea sector as such?
No, it's not an area that we track, and largely because it's very difficult to predict commodity prices for something like tea. It's very susceptible to small changes. Just like the Kenya disruption is resulting in higher tea prices. What will happen next year is again difficult to say. So for us, it's as a long-term investor, unless you have a good view on what are the long-term tea prices going to be and whether that will allow McLeod Russel to make a good margin on its production, it's a very difficult call to make, and therefore we largely stay away from taking such bets.
Okay, so that's the view that's coming in on McLeod Russel. pretty much not a long-term fundamental bet, but probably a short-term trading play is something that could be possible as per our guess. So that's what we're talking about. Not the best of return of ratios also currently, and Lancelot believes that 22 times FY19 a commodity stock is rather expensive. So that's the view that's coming in on McLeod Russell. The next stock is a counter that has been buzzing both on the upside and downside. You never know which way it will turn. So Reliance Communication, it's down almost I don't know how much down it is, because from the peak it was almost down 95%, but recently it is up almost 35 to 40% up from the recent lows. The company indicating that it cannot pay back its bondholders. They don't know what exactly is happening. A couple of their deals being called off, but the land bank is still there, and that is something that they say they plan to monetize. What's the view ahead for Reliance Communication? Sharmila, any hope for someone holding a Reliance Communication or looking to enter Reliance Communication? Is a turnaround actually possible, the land bank story that they say, or it's just someone should just avoid Reliance Communication?
I think long-term investors should definitely avoid, because I think taking a call for the entire telecom as a sector, I think only the strong players look like they will really ride this one out. So in that you have Reliance Jio, which is sort of going all guns out really, to get market share, and then you have Vodafone and you have Airtel. So it looks very difficult that anybody can really stand against these these three big players. And Reliance Communication has its own share of trouble, apart from the fact that recently they said they can't pay lenders back. So yes, I think the stock corrected so much. I think I was just seeing the 52-week high was 55 levels, and then it corrected, as you're saying, to sort of below.
It went below 10.
Below 10, and now it's back again at 14. So those kind of moves for people who want to take risk could be possible. But that said, I think if I were to take a call on telecom as a play going ahead, I would. The only listed play that you can take is Reliance via Reliance Jio via Reliance and Airtel. So I would still go with an Airtel.
Idea is also good.
Idea, but hopefully that will also get sorted. Going forward, if their deal goes through, then you don't know what will happen with that.
Amit, your view on Reliance Communication? A few days ago when it went below 10, I think the joke went out that Vada Pav was more expensive than a Reliance Jio, but it's proved it's up almost 35% from that level. So for a trader, yes, that's a lot of money, but what should one do with Reliance Communication?
No, as Sharmila mentioned, if you have a long-term view on the investing front, this is not something that you can even touch. You can't come close to. The business is no longer viable by any stretch of imagination. The thing with monetizing land bank is it takes such a long time to do that. Their ability to shed debt by selling land is unlikely to happen over the short term, and the debt that is going to happen for the business is happening in the short term. It's every quarter that they're continuing their operations, they're bleeding more money. So as a business, it's not even close to viability. There is no path to viability for Reliance Communications in that sense. So I believe for equity value is probably close to zero. The only question that remains is how much money will the debt holders get back on their principal? Will they get 50 cents on the dollar, or it will be even lower? That's the key question that people need to figure out. They might be buying the debt of Reliance. Reliance Communication might be a better investment over the longer term than buying the stock of Reliance Communications.
But any view on the telecom sector as a space? Would you believe that, as she spoke, that it will be better to stick to the larger ones? But do you feel that telecom again has bottomed out because of what Jio did with its EBIT numbers?
Yeah, so it's at an interesting place, the telecom sector. What Jio has done is, one, it has definitely killed a lot of players, but for the survivors, it has made the market far more attractive. So if the likes of Bharti Airtel or an Idea, Vodafone combined, it's become a three-legged race now, pretty much. I'm ignoring BSNL, MTNL, all others who are surviving, who will only survive because of government largesse and not because of the business reasons. But for the likes of Bharti Airtel, which is the leader, even someone like Reliance Jio, the opportunity now is a three-player market allows them to make profits over the longer term. So if maybe next 1 year will be painful, next 2-3 years might be painful, but 10 years down the line, if we believe that telecom is something that people will require, then something like a Bharti Airtel could be quite attractive.
Okay, Lancelot, any view on Reliance Communication? It's a too negative, but
I'm also negative on the stock because, like Amit says, with the 45,000 crore debt, even if you sell off your tower business, all the real estate holdings and the fiber optic business, you will still maybe not realize the 45,000 crores.
Okay.
That's one point. Second is, there is no business case which can say that, okay, this is my business and this is how I generate return, and that return will flow back to shareholders. So unless the company is able to demonstrate a business case whereby it's able to generate return for shareholders, there is no business really. So it's a period when you're looking at either liquidation or somebody just taking over the assets and their equity.
But that could be a potential target.
Yeah.
It could be a potential target because they have some assets which could.
So even the asset sale, whether the asset sale will cover the outstanding loans plus the interest is a question mark. If it does cover, then only you may see something coming back to shareholders, but that's a very remote possibility.
I think the bondholders are also reconciled to the fact that we will not get the entire principal. There's already a restructuring that's happened. Now there will be conversion of debt to equity. I think the earlier price was almost 2x of the current market price. So the banks might be reluctant to convert debt at that higher price. So even if that happens, if it happens at the current market price, the dilution will be crazy. Even after that, is there a business case or not? Even if all the debt has been repaid, even after that, I'm not certain if there is a business case.
Okay, so that's the view that's coming in on Reliance Communication. It's a triple thumbs down that comes in for Reliance Communication. All our three guests believe that there's no business model that is left. Even after they sell off all their assets, still the debt will remain. And Amit also says that, it's very doubtful that even the debt holders will probably get anything or no. Let's move on to the next stock, and that is Phoenix Mill. It's moved up significantly, but the counter is down almost more than 10% in the last few days. From the recent highs, it's down almost 10%. What's plaguing the counter? And yesterday, very interesting comments coming in from Kishore Biani in terms of opening a significant amount, more than 1,000 stores. So he's betting big on the retail space. So would you bet on someone like a Phoenix Mills, which is also expanding significantly in the retail space? I'll start with you, Sharmila. Any view on Phoenix Mills?
See, I think if you look at it from a point of view that there is a tendency in the market to like consumption-based kind of themes. So I think from that perspective, Phoenix Mills is sort of fits the bill because their results have been decent. The kind of what the strategy they've applied, where they've actually invested in their own projects, etc., over the last 3-4 years. So they show confidence in their business. Their malls are seem to be in at least the metros getting good footfalls. So their rental incomes, if you look at them over the last year, they've been pretty steady. But what I don't like really about the stock is the fact that it is so thinly traded. I think in the morning when I was looking at the stock, it was 505 with 2,000 shares traded, and now with 12,000 shares traded is down, 496. So I think these kind of plays are a little dangerous to get into. I would look for some other names, though I would say that from a business model perspective, this one looks okay.
Yeah, but I'm really surprised of the volume because the brokerages that cover it, there are 10 brokerages that cover it. All 10 of them have a buy on it, and these are not small brokerages. These are brokerages like JP Morgan and Macquarie and CLSA, which actually UBSA, all of them cover these counters. So I'm really surprised that there is not enough volume. Amit, the 21 times valuation, the return ratio is not the best, 4 to 7 times percent. What do you make of Phoenix Mills?
Yeah, so the return ratios are unlikely to be good for a long term because they own the assets. It takes a long time to generate returns on this. So, for example, a lot of their assets right now are not generating any returns significantly, be it the residential projects in Bangalore or something like the Kurla Mall, which is not doing that well, has not done that well. So, a large part of the value of Phoenix Mills is still that high street Phoenix Mall. Probably 40% of the value of the business lies in that. But the positive I would look at here is this is a credible mall operator, has now access to capital with the Canadian Pension Board joint venture. They could fairly expand over the next few years using this capital. The longer term risk for me is what happens to malls as a business model once e-commerce keeps picking up space. And I probably am being too paranoid because the risk might be too longer term and it doesn't impact even next 5-10 years maybe because India is such a strong consumption growth story. But that's something that would worry me. RERA and GST, if land prices start coming down, that's again slightly a risk, but it might also be a positive because land prices might crash and that might allow more players to build large malls. And so if higher competition is always negative for the profits of existing malls that they have. So it's really very difficult to assess whether Phoenix would make a good bet from current prices. So, I would be neutral therefore on this.
What about you, Lancelot? Are some of these concerns valid, what he's saying? Is e-commerce such a big threat for, let's say, a Phoenix Mills? He said that, probably it's a little too much, but some of the other concerns that he pointed out?
I think, Phoenix has proven that if you look at the mall operators, many mall operators have come in and they've sold off and they've got rid of their assets. But Phoenix, with their mixed use land usage, has been successful in developing, a good amount of, let's say, captive audience. Second interesting thing Phoenix has done is, which is very different, is that they have a fixed base which is very low, and they are linked to the turnover that the individual shops do. So the rentals that are there, they actually have a very low base. So it attracts a larger number of people, and their average rental has been about 180 rupees a square foot, which is much higher than what other people are getting in the space. So I think they've proven that yes, there is a demand and there is a way to bring in footfalls, and that footfalls is also generating some amount of cash for the mall, for the shops in the mall, which is then fueling the increase in rent, because nobody will pay a higher rent if there's no business. So from a business case, they've proven that, and now with Canadian Pension Board putting in money, they can increase their capacity by another 6 million to over 6 million square feet.
Okay.
So that should give a boost, because they're not making the investment. The investment is coming in from the Canadian Pension Board, but they will be, as mall operators, generating revenue out of this because they get management fees, etc. So that will add to their profits without hitting the investment, which is the larger part of the business. So there is also a probability that they can also go the the investment trust way and move assets into a investment trust, so that they generate cash from there and then use that for growing their business. It will make it an asset light model. So I think the model will keep evolving and there will be some improvement, but the pricing at which it is trading at this point in time is very, very high, and it's probably factoring in all the positives and not considering any negatives.
21, 22 times is expensive.
I think it is expensive.
So what would an ideal mall operator, what kind of valuation?
You should not trade beyond 12 to 15 times.
Okay, so that's almost double, than almost more than 50% more than what it
So one should wait, because at this point in time, because of liquidity, since you have low liquidity, whenever there's demand, the prices shoot up. And you could see the stock, again correct and come to a reasonable level when one can look at it.
Okay, so that's the view that's coming in on Phoenix Mills. But not too negative, not too positive. It's pretty much a consensus neutral view on the counter. It's a wait and watch approach for Phoenix Mills. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, the next stock that we're talking about is IFB Industries, one of the most buzzing stocks. It's up almost 200% in the last 1 year. If you're looking at the return ratios, ROA of 6%, ROE and ROC of close to 12%. Expensive, it's almost trading at 67 times this year valuation and 45 times next year, 8 times price to book and a single digit margin. No doubt it has Westbridge brought into it, and from that level the counter has moved up significantly. Amit, what does Westbridge see in the company that with such return ratios and high valuation? Westbridge is definitely seeing something in this company which is making it move. Any view on IFB?
No, it fits with Westbridge's overall strategy, which is long-term consumption trends. So IFB is clearly catering to the long-term consumption trend. They have a fairly strong niche positioning in washing machine category, have market leadership in front load washing machine, small market share in the top load washing machine. So, and as a category, everyone would agree washing machines is something that would keep increasing in sales over the next fairly long term as the per capita income goes up, as discretionary spending goes up in India. So I think it fits perfectly well with their investment strategy, because there's growth, there is market leadership in at least a niche segment at least. So
What's your view?
So yeah, even I like the space. I like the opportunity that they're catering to. But as you rightly mentioned, the valuations are something in a very completely bonkers territory in that sense. So I would stay negative and I would be bearish on this purely because of valuation reasons. Regarding current margins, I would not be so concerned about it. If the business does well, if they are able to grow volumes in double digit, there tends to be operating leverage in such businesses. Margins tend to improve. If you look at most consumption stories, even the likes of Voltas, Symphony, the margins that they had earlier in their growth journey was much lower than what they enjoy currently right now. So the question to ask is, will they be able to sustain this market share and be able to increase market share over the next few years?
Do you think?
I'm not sure, but I like the space that they're targeting.
Okay, Lancelot, they're leaders in washing machine, there's no doubt, but it's a small space in a space which is growing. Because it's not present all across. When with competition coming in significantly fast with the Samsungs and the LGs, would this valuation be sustainable? Do you think that it makes sense for someone to give such valuations to an IFB Industries?
Well, I think the valuation is very high, and you are factoring in 45 times FY19 earnings, which is a bit aggressive because it's very easy when there is a new business segment which is offering high margins for people to enter. Most of the players who will come in will also have similar products, similar pricing. They'll be able to penetrate the market in the tier 2 towns, etc., which is where the bulk of the sales are happening. So given that background, I think the margins sustenance is going to be a big issue, and one will have to see how these companies perform. So that risk hasn't been factored into the pricing at this point in time. So you see 1 or 2 negative quarters or slowdown in terms of sales, and then everybody is talking about more sensible levels of valuation.
What about you, Sharmila? Any view on IFB Industries?
I think their niche product, as what we've been discussing, washing machines, front loading. I think they have a very healthy market share there, and I see that sustaining completely. I'm not so worried about the margin front, and it really ticks all the boxes in terms of the fact that there is a good consumption demand. The entire sector has gotten re-rated, so obviously IFB was part of all the stocks that went up. I mean, you can name the stock and you will see that it's gone up. It's just that the price and the valuation is trading at currently. That is what is actually the only worry really here. Because I think in a short period of almost 2 months, the stock has doubled.
Yes.
So it's really worrying when you see that kind of a price movement, and then at this price, do you want to enter for the long term?
And I think the real move started once Westbridge entered, because it was stagnant at that price.
At 790, 750.
And
great,
then I think once Westbridge entered, I think that is where the fancy for the stock actually picked up. So that's the view that we're getting in on IFB Industries. Amit is negative on it. Other two guests are neutral on it, given the fact that they believe valuations at these levels, 45 times next year earnings, is rather expensive for the company. And the last one, we've kept it as a sector and we've kept it open, is the real estate sector, because it's doubled from the demonetization lows. What exactly is happening? You take the stock, any stock, and it's actually doubled when everyone thought that post demonetization real estate will be the worst hit. It's sprung a surprise. India Bulls is up 200% this year, Godrej up 150%, Prestige up almost 100%, DLF up 100%. Lancelot, I'll start with you. What's your pick in the real estate space? Is this sustainable?
I think it should be sustainable for companies which have strong balance sheets, which have low leverage, and which have a focused business model of acquiring parcels of land and selling it to segments which are affordable. So in that space, I feel the Shobha Developers would be one company which has, which fits all the requirements.
Okay, what's your rationale for liking Shobha?
See, Shobha is again focused on the mid-segment space.
Okay.
They have already accumulated parcels of land, and if you see, they complete their projects, provide delivery, and they have been very focused in terms of keeping debt low. So they're not highly leveraged as many of the real estate companies are. So they will be generating almost 450 crores of free cash flow in the next year, which should help them, in terms of acquiring more parcels of land. So while the short term there may be a surplus of, let's say, unsold flats and inventory, which may put a little pressure on terms of pricing, I think the longer term story will play out, especially with all the regulations coming in.
Okay, so Shobha is your top pick in the real estate space. Sharmila, any view on the real estate space?
Honestly, I have not liked this as a sector for the longest time, because I would agree with Lancelot, but I find very few stocks which actually fit that bill, where corporate governance issues are low, leverage is low, etc., etc. I would have probably picked Godrej Properties. That was the only stock that I had sort of recommended. And I think the thing that's really working in favor of the sector is the fact that there's this whole focus on low-cost housing, etc. So my strategy for the last couple of years has been to really look at the proxy play. So to look at the housing finance companies, because there is a case that you can make that cost of finance is going to come down, etc. So and if there is really a focus on real home buyers as opposed to investors, then you should see those companies doing decent results and therefore do sort of okay. So LIC Housing Finance within that space, or a Diwan Housing, or any of the other. You could come up with some other names as well. So those are the stocks that I've looked at, or the paint companies, or a Kajaria ceramics style companies. So the focus has been to really look at the proxy play and buy.
But if real estate, if you're negative on the real estate and that only is not growing, how will if the house is only not sold, how will the housing finance company do any kind of business? Or a Asian Paint sell? Asian Paints is a different fish, because or a tile company. How if the base is only not.
So two things. One is that not that real estate will do badly, but I don't like the companies within that space, because there are a lot of corporate governance issues also with the largest players. Every now and then these issues crop up. So you don't want to really get into that. You don't know their exact land bank situation. There are so many other issues as well. It's a grey area. Very honestly, I don't think that it's the kind of sector where you will really get all the answers. Sort of like what is the actual price you bought it at, what is your development cost, what are you selling at. Now hopefully with RERA, a lot of these grey areas will slowly start disappearing. So I would look at that as a positive. And again, if you look at the data that's come up in the last 6 months to the actual sales done and new projects registered, it's not been that great.
Yes.
So it's been pretty dismal actually, the number. But the reason why you like housing finance companies is there is a need for housing. And you will have people who will be taking loans to hire. And there is an aspirational need to even do home improvement, which is why I think a paint and a tile company, because the existing houses will go for upgrades, offices will go for upgrades. So you will see demand coming there.
Okay, Amit, final view on real estate. Are you liking the or no?
Yeah, so again, I'm like Sharmila, negative on pretty much the entire real estate space, and largely from a business model perspective. Real estate development as a business model itself is not a very profitable business, and when I say that, you can have good players, you can have bad players, but even the good players struggle to make a very good profit margin on that. Okay. So and generating a decent ROE even for a good player is over a longer tenure is actually quite difficult. So even if there is this demand shift from the unorganized players to the organized players because of RERA or GST, it's unlikely that many of these companies will be able to deliver value to the shareholders, which is profits and cash in the pockets of shareholders. Just to give you a context, the largest home building company in the US has a market cap of less than $20 billion. That just shows that such a large market, and yet the largest company is not really does not have a very high value. But in India, we seem to be ascribing a lot of value to the same business model by saying that there's going to be huge demand. The demand is going to be there, maybe not next year, 2 years, but at least over the longer term, because we will require real estate. But will that result in profits and cash in the shareholders' pockets? I'm doubtful of that.
Okay, so that's the view that's coming in on the real estate sector from all our guests. We had quite a few views on that. Before we wrap up on the show, here's a quick recap of the guest view on the stocks that we have covered till now. Lancelot, Sharmila and Amit, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.